This is the 3-bar play, and you clicked on this video because you saw it's the only pattern you need for day trading, and that is completely true. The 3-bar play is responsible for getting me funded through prop firms like Apex Trader Funding, and it is the breadwinner in my trading system. In this video, I'll cover the strategy that makes this work, and I'll cover a real-life example in the futures market. But don't worry, you can use this on any asset class, whether it be futures, options, stocks, forex, or crypto. At the end of the day, it's all price action, which is rational human behavior, so it can be applied to any market. So let's go ahead and dive deep into how I use such a simplistic candle formation to make consistent profits week after week. The thing is, this is nothing new and nothing special. All traders know the theory behind this because it's none other but a bull flag. If you recall, a bull flag is a price action pattern where you have a move up followed by consolidation, and then if it breaks out, traders are looking to get a continuation for about the same length as the first leg, because the first leg is the reference that algorithms use to place their take profit limit orders. So what makes the 3-bar play special? In my trading system, is just something quick I could use to scan through the daily chart during the pre-market every morning to see what names might be in play for the day. All it does is give an idea what names are worth to trade for that day, because the 3-bar play is not just a bull flag, it's a bull flag that's visible to the higher time frame players. So when these higher time frame players enter to catch a scalp on the daily chart, they provide the fuel to day traders like you and me on the smaller time frame, which creates nice explosive trend days. So that's the entire reason and theory of why it works so well. It's a way to find names that have the potential to form a trend day, which all traders agree are the easiest and most profitable days to trade. You only need to catch one of these to make your week, and in some cases even your month. So let's go through a real life example here in the chart of silver futures. I'm going to walk you through of how you can structure a trade using this knowledge, because it's one thing to identify a name, but it's another thing to see what criteria have to be met, how to structure risk, and all that fun stuff. So on the regular trading hours chart, we see a couple of important things. One, we are in an uptrend because we're putting in higher lows and higher highs, right? It's very important that we're in some sort of bullish leg up and not at the top of a trading range or a bear flag. So next thing is on the daily chart, we see a big move up followed by an inside bar. Now, we know that if we break above this inside bar's high, we should get a continuation to the upside if bulls are present to fill this leg 1 equals leg 2 measured move. To increase the probability and to structure my entry and risk for the trade, I use specific support and resistance levels to gauge where price action opens or volume comes in and see if the risk to reward is worth it to enter, to see what levels align with the ATR, the average true range, and etc. So there's two types of levels I draw. I call one the level of reference, and this is a level that is important for me to consider an entry. The other levels are just your typical support and resistance lines that are derived from higher time frames. I'll go over both of these, but in short, the most important is to see where price is in relation to the level of reference. It's very important that we are currently gapping above the level of reference in the extended trading hour session. Now, the level of reference in this case is the 29.95 level, and this level is derived from the hourly chart on the regular trading hours because that's where majority of the trading volume takes place. These levels are specifically drawn from trend changes on the hourly chart off the opening print. For example, here we have a leg down, and it originated starting from this green to red flip here. So we plot the level at the trend changing bar's opening print. The whole reasoning behind this is that this is an area where shorts have initiated because in the stock market there are both bullish and bearish institutions present and both are profitable. If we gap above this area, it's likely that shorts will want to get out break even, converting to limit order bulls. And with the context of the 3-bar play, aka a bull flag, daily time frame scalpers will be using the previous supply, which will be broken through, which becomes demand or SR flip. It doesn't matter what you call it. These are levels of reference that end up being areas that both bulls and bears are fighting for. So getting above this level before institutions are present is great because now bears are trapped in a losing trade and bulls are also trapped out of a good trade. So they're both eager to buy at around this area. The whole thesis is now if we get a pullback to that level during a time when institutions are back in, aka when volume comes in, we will have to wait and see if limit orders come in off the level of reference, because then it is likely that we get a bounce and see our prices as shorts get out break even, final bears give up, adding to aggressive buy orders, and bulls add on to their position, fueling the intraday time frame into a nice trend. Most of the time volume comes in during market open, but it varies from assets, such as silver in this case. It actually gets institutional activity around 5:30 a.m. PST, which is 1 hour before the US market opens. So you need to know how your asset trades. And guys, this is not rocket science. You can just go back in the past. You can see here every time when we get around 5:30 a.m. PST, that's when volume picks up, and that's when we know that institutions are present and trading this name. So now when we structure a trade here, if you recall at the beginning of the video, a bull flag is usually made up from a leg 1 equals leg 2 measured move. So we could use this recent move up before this consolidation to project the measured move and see how far we can anticipate price to go if we get a breakout before algos start to take their profits. You can see that the only level that falls within this measured move is my 30.795 level, which is drawn from a 4-hour resistance. This will be the main profit target. As for the entry, the proper entry here would be on this 5-minute chart. I personally entered on the 2-minute chart so I can afford the risk as I can tighten my stop loss. But that also greatly reduces the probability as you get stopped out more frequently. But over the span of 100 trades, you end up making around the same profits. If you took the correct entry on the 5-minute chart, it would be here at this high 2 bull flag, as it's a second entry after there is a confirmation that limit order bulls are indeed present right at the level of reference. The correct stop loss placement is just below the low of this potential higher low in the after hours session. This makes it around the 3R trade. Once we get these 1 and 2 bull bars breaking above the previous high, you can tighten the stop loss to this 5-minute leg dip that happened at the level of reference, which increases this trade from a 3R to now a 5R trade. Remember, stop losses are only moved to places where your trade thesis becomes void, invalid. If you're betting on an uptrend, price should not fall below confirmed higher lows. So shortly after 40 minutes into the trade, the first profit target hits. It's up to you how you manage your trades. I personally like to take a chunk of profit at the place I planned for and then leave a runner until the trend is broken. In this case, we see that after this pullback, we have a breakout bar, and after 2 bars later, we get the follow through bar. You can then move the stop loss into profit below this confirmed higher low. So now we get another pullback here, and once again, we get a breakout above the previous high followed by a follow through bar. You have 2 stop placement options here. Safer one being at this low, as it would also align with a 15-minute higher low. But I personally stay on the 5-minute time frame for management, so I use this 5-minute higher low. So now you understand how this works. You have breakout, follow through, you raise your stop. Pullback, breakout, follow through, raise stop. Now at this point, we're getting late in session. So if I didn't already get out at this next level, I put a take profit limit order at this previous high because there's not enough time left to continue following this trend and trailing a stop. Great, so I hope you learned something in this video. If you want me to cover more trading examples, give this video a like and let me know what you want to see in the comments below.